Markets rarely change suddenly. They drift, they bend, they signal, and most large companies still miss what happens right in front of them, not because the shift is hidden, but because it does not announce itself loudly enough to interrupt momentum. Real market shifts start as minor inconveniences. A new pricing model, a different distribution channel, a change in customer behavior that seems temporary. Early on, nothing breaks. Revenue holds, margins survive, customers stay, so the shift is classified as noise. Large organizations are built to assume continuity. Forecasts extend existing curves. Plans assume stable demand. Strategies rely on gradual change. This creates confidence. Confidence becomes expectation. Expectation becomes blindness. When change is incremental, it feels manageable, until it compounds. Market shifts don't arrive as conclusions. They arrive as weak signals, fragmented data, contradictory feedback, inconsistent patterns. Large companies prefer certainty, so they wait for confirmation. By the time confirmation arrives, the window for early action is gone. Big companies think in scale. Ideas are evaluated by, how big can this be for us? But market shifts begin small, too small to matter, too small to justify attention, too small to survive internal prioritization. By the time they are big enough, they belong to someone else. Customers adapt before they complain. They change behavior quietly. They find workarounds. They reduce usage. By the time dissatisfaction is voiced, it has already turned into habit. Customer data shows loyalty, while behavior signals departure. Companies listen to words, not patterns. Most analysis explains what already happened. Trends are identified after they are established. Reports describe past movement. Market shifts require forward interpretation. That feels speculative. Executives train to avoid speculation. Wait for evidence. Evidence arrives after displacement. Smaller players see shifts earlier, because they are not anchored. They don't protect existing revenue. They don't defend legacy models. They move toward change, because they have less to lose. Large companies hesitate, because they have more to protect. Early adopters don't look like your best customers. They are price sensitive. They tolerate imperfections. They value flexibility over polish. Large companies ignore them. Later, these users define the market. By then, loyalty has already formed. Strong performance delays urgency. When numbers look healthy, concern feels premature. Questions sound pessimistic. Preparation looks unnecessary. Success anesthetizes awareness. By the time decline appears, the shift is no longer subtle. Large companies trust their brand. They believe recognition ensures relevance. But brand does not stop change. It only delays realization. When customers leave, they don't announce it. They simply don't come back. At first, companies try to respond. Small adjustments, minor features, incremental pricing changes. But these are defensive moves. They preserve the old model, instead of embracing the new one. The shift continues. Buying into a new market does not guarantee understanding it. Acquisitions import products, not instincts. The parent organization often forces old logic onto new behavior. The shift is absorbed and neutralized. Market shifts reward early adaptation. Late movers face compressed timelines. They must learn faster, invest more, change deeper, all while under pressure. Early movers learn slowly. Late movers panic quickly. The most important moment is when the shift looks reversible. When leadership says, "This might pass." That moment feels calm. It is the last moment. With optionality, big companies are not slow. They are optimized. Optimized for efficiency. Optimized for scale. Optimized for consistency. Market shifts demand flexibility. Optimization resists it. They watch behavior, not declarations. They treat weak signals seriously. They move before certainty. They accept temporary inefficiency to preserve future relevance. They don't wait to be proven wrong. Companies don't fail because they didn't see the shift. They fail because they waited too long to accept what they already saw. Market shifts are not invisible. They are uncomfortable. They don't fit forecasts. They don't respect timelines. They don't ask for readiness. They arrive quietly. And the organizations that survive are not the ones with the most data, but the ones willing to act before the data feels safe.